Okay, traders, so welcome to an introduction to indicators. In this section of the course, we're going to be talking about the two main indicators we're going to use in the transition phase to help with the creation of that pullback strategy. Now, we will look at other indicators that we're going to use in this course later on in the advanced section, but in this video, we're just going to look at those two main indicators we're going to be using going forward throughout the transition phase of the course. One of those indicators is the ATR, or average true range indicator. What this indicator does is shows you the average true range of the last 14 candles by default, and that's what we're going to use as the default settings. I'll show you guys how to put that indicator on here, as well as the moving average we're going to be using for the pullback strategy in the transition phase. So those two indicators, the moving average and the ATR, is what we're going to learn how to use in this video, and we're going to learn how to put them on a chart as well. What I'm currently using is tradingview.com. This is the charting platform that I use in order to do my analysis. I would suggest you do the same. But if you decide to use MetaTrader 4 or NinjaTrader or any other charting platform for your trading, then you'll just have to YouTube how to find these indicators on that platform. But here on TradingView, you go up here. If you'll look up here at the top part of your screen, you go to indicators. Average true range is going to be right here, the average true range indicator. So click that, and we're using this at its default setting. So for the average true range indicator, the default setting on this indicator is 14, meaning that we're looking at the last 14 candles that have been printed on any specific time frame and coming up with an average amount that those candles have moved. We're going to keep this as its default setting. The default setting is RMA. There's no reason to change that. We're going to keep it that way. And what I like to do is take this arrow right over here and move that to the top part of my chart and make it pretty small so it doesn't get in the way of any of my other charting. So here, now we have the ATR indicator. This is one of the main indicators we're going to be using in order to determine stop loss placement. That's the reason we have this ATR indicator here, is because it gives us a more adjustable way to place stops than just saying we want to place a 30 pip stop or a 20 pip stop. Instead, now we can look at what the average of the last 14 candles have been in case we have a really volatile market that's moving around a lot like so, or if we have a really small moving market that's not making very large moves, we can adjust our stop loss accordingly. And the non-subjective way we're going to be able to tell whether a market is volatile or moving slowly with smaller moves is by utilizing this ATR indicator right here. What we're going to do in order to figure out the ATR of a specific candle is hold our mouse over the candle. And what we have to do once doing that is look up here. If you'll look to the top left-hand side of the screen, right here is a number, 0.0032. That means that currently the average true range of the euro dollar is 32 pips. So that's how we can determine what the average true range, what the ATR of a specific candle is. And we're going to go through how we're going to use that to place a stop loss whenever we talk about the pullback strategy in the next section of the course. Right now, all you need to know is that hovering over a specific candle and looking to the top left-hand corner of the screen here where it says ATR is how you figure out what the actual ATR of that specific candle is. So here we have a 32 pip ATR on the euro dollar. And hopefully now you understand exactly how to use the ATR indicator. We're going to talk about how to actually use it with a strategy and how to incorporate it into pullback strategy when it comes to stop loss placement and target placement a little later on in the course, right in the transition phase. So that's how we find the ATR, that's how we put it on the chart, and that's how we're going to be using it. What is the other indicator we're going to use? Well, it's an exponential moving average. Same thing, in order to find that, we go up here to indicators, top left-hand side of your screen, click that, and scroll all the way down to moving average exponential right here. This is all in the built-ins of the indicators list on TradingView. Click that. Now, this comes originally with a 9. What we're going to do, this is an exponential moving average. We're going to set to 50. We're going to leave the offset at 0 and the source at close. I changed this style to thicken the line a little bit for myself, for me to be able to see it a little better. And I always change it to blue as well, just to separate my moving averages. So with that done, now I just click OK. And now we have our 50 EMA, or a 50 exponential moving average, placed on the chart, which is the other indicator we're going to be using for the transition phase of this course. Now, something important to note about this 50 EMA is that I see a lot of traders trading wrong with moving averages, or not necessarily wrong. It's better to have an open mind about trading. Whatever they're doing may be working, but for the purpose of this course, the 50 EMA is just a reference. We're not going to be placing trades based on when candles close below the 50 EMA. or something like that. We're using it as a reference guide, with the market being under the 50 EMA, defining that as a downtrend as long as we're making lower lows and lower highs, and with the market being above the 50 EMA, defining that as an uptrend as long as the market's making higher lows and higher highs. So that's the correct way we're going to be utilizing this in this course, in the transition phase of the course, whenever we start to talk about the pullback strategy. And we'll go over much more about the moving average, a little more about the ATR, how we're going to utilize them to create strategies in the next section of the course, in the transition phase. So with that said, hopefully now you have an idea of how to put these indicators on the chart and how we're going to use them correctly. And something else I'd like to mention before we move on to the next section of the course is that what I hear a lot from traders is a question about what the magic moving average is. Is there a magic moving average that when you place it on the chart, every time the market touches it, it's going to move up or down, or it's going to tell trend better than any other moving average out there? The 50 EMA is not a magic moving average. We're not trying to find the magic moving average. What the 50 EMA does is gives us a non-subjective way to pick which direction we want to trade. And that's the importance of this moving average. It's not the best moving average out there. I don't know what is. I haven't tested enough moving averages to really be able to answer that question, but I know that utilizing this 50 EMA as a bias to give me which direction I'm going to be trading on this specific strategy, combining that with the specific rules we're going to talk about in the transition phase for the pullback strategy, combining all that together to make a strategy does give me an edge over the market. That's what I know. I don't know that the 50 EMA is the best moving average out there. That's not something I'm interested in even finding out. I just know that combining this 50 EMA with the other rules and stipulations and conditions we're going to talk about in the transition phase give me an edge over the market. And the reason we're using moving averages, the reason we're using the ATR, is because they give us a non-subjective way to make rules for a strategy. And what you'll notice throughout your trading career is that having things that are non-subjective, that are like set in stone rules, makes trading much, much easier. So that's going to do it for the introduction to indicators and the correct way we're going to be using them. Again, the reason we use indicators is not for entry techniques most of the time. More than likely, the reason for indicators that we're going to be using in this course is going to be to help us create non-subjective rules around strategies. The next thing we're going to take a look at in this course is the candlestick pattern entry reasons we're going to be using in the transition phase. So I'll see you guys in that video.